We concentrate now on the swearing-in ceremony and what will be the most important and maybe priority that the government should attend to, especially in the financial sector. Of course, there is a lot of toing and froing on who will be the finance minister, but there's no denying that the financial sector is in need of a lot of attention. To check out what should be the priorities, Hitendra Dave, Head of Global Banking and Markets, HSBC India, joins us now. Hitendra, good morning. Thank you very much indeed for joining us. Yeah, like I told you that we are in this still in a confusion as to who may get the finance portfolio. But what do you think is the key priority, or are the key priorities?
Yeah, morning, Lata, and pleasure to be here. I think it's very clear that all incoming data since almost, I would say, last Diwali have indicated that there is a slowdown, and it's a various series of sectors which we're experiencing it. So I think the number one task for the finance ministry and the finance minister, of course, would be to try and ascertain, whether it's cyclical, whether it's sector specific, whether it's structural. If it's structural, what should be done? If it's cyclical, then obviously you sort of can afford to be a bit more patient in policy making and decision making. So I think, however, my own guess is that, when we get the GDP print for Q4 FY 19-20, for the quarter ended March, it might be disappointingly low, and that should, I think, spur people into action a lot more decisively.
Okay. What are you expecting? 6%, below 6%? Fourth quarter?
I think base case looks like 6% with a possible downside risk there, because all the indicators for that quarter across a number of sectors have indicated significant contraction in demand vis-a-vis the year back numbers. I think that it's also a quarter in which government spending obviously got, there was a put of brakes on government spending to align with the budget that was made earlier. So yes, I think, it certainly looks like the full year projections will have to be scaled down for the previous year. And if the current FI we have entered with that sort of momentum, even the current projection, 7.2 or so for this FI, you would have to say that, if the momentum is slow, unless there is a significant U-turn which people have experienced either in April or in May or immediately, then even that potentially could be look for a review for downward. So yes, I think growth is the biggest policy challenge, or the weakness in growth is the biggest policy challenge, in my opinion, in front of all policymakers.
Actually, Hitendra, hi, good morning. This is Sonia here. It's not just an India challenge, right? It's a global growth challenge that we are facing right now. And the bond market is giving some ominous warning signs about the global economy. I mean, an inverted yield curve has typically not been a good sign in the past. How would you read into that?
No, I think, morning, Sonia. I think it's a very fair point you make that it is unfortunate for us at a level that our slowdown, which is entirely due to domestic factors, is coinciding with the, at least financial markets indicating that there is a growth slowdown round the corner in the big economies like US and maybe even the Eurozone. And to that extent that if external demand was going to bail you out, it doesn't look like that's going to be bailing you out. To the point on inverted yield curves, I think many times it's obviously it's been a lead indicator of recessions. In other situations, it's been an indicator of other things. So, I think it's too early. To my mind, an economy where the unemployment rate is close to, 3.6% or 3.7%, there has to be something material to trigger the kind of recessionary indicators that an inverted yield curve is giving. But from an India perspective, to the extent that Indian bond yields have also been sliding, I think so far Indian bond yields were reacting largely to softer than expected inflation prints. My guess is a lot more people now are focusing not so much on inflation, but on the fact that we spoke about, that there are too many sectors reporting relatively weak volume data. And is that indicative of a wider slowdown in the economy, and whether the policymakers would need to react to that?
No, I want to come to you on that causes of that slowdown. We had R.C. Bhargava yesterday on it. But before that, just this NBFC piece and housing finance piece, is this just good supply of overall market liquidity that will suffice? Or do you think the government, the North Bloc, has to do something in terms of a lender of the last resort arrangement or something like that?
No, my guess is that liquidity in the system is available for borrowers that lenders find appropriately safe or where they feel creditworthiness exists. So I'm not sure liquidity in the banking system is going to solve the problem of the NBFCs that cannot access credit. So I'm sure you are aware of the fact that there are lots of high quality NBFCs that are able to raise money from banks and from capital markets, and they are not experiencing severe challenges. There might be a cost issue which has gone up for all borrowers across the street. So I don't think liquidity is going to address the problem of NBFCs per se. And then if we say, okay, can you have a directed window only at NBFCs? I think that's a bit of a moral hazard you get into, because today it is NBFCs, tomorrow it could be some other sectors which could become untouchable from a banking sector perspective. My sense is the NBFC sector solution really lies in capital. I think the companies need to demonstrate that they can raise equity, and once they raise equity, then that should provide the confidence that other lenders will need to be able to inject the debt funds that those companies seek. Overall on liquidity, I would say that I think it's time the Reserve Bank finally took a call on this whole model of being preferring to be in deficit mode versus preferring to be in surplus mode.
What is the immediate solution for a pickup in private investment or even in, say, corporate capex? I mean, these solutions like land reforms, labor reforms are sweeping motherhood statements for the moment, because it will take a long time before things actually happen on the ground. But according to you, what needs to be immediately done?
My own guess is I think all reforms will tend to have long-term payoffs, and we should continue to focus on those. That said, private sector capex will follow if there is demand which is visible in the near-term horizon or in the medium-term horizon. If demand indicators are weak, I see very little reason why private industry would want to put capital and increase production capacities. I fear that our private sector is still going through what it has been going through for the last 2-3 years, which is balance sheet repair, and that I can't see changing, at least in this FI, going forward.
Now, from your previous answer, I'm gleaning that what you're saying is the problem or the solution lies at the Reserve Bank end, not really immediately at the North Block end. You think we need to revisit, for instance, you should not do variable rate reverse repo, maybe do fixed rate reverse repo, do something that, pushes down yields? Is that what you're hinting at?
No, I would frame the issue in a slightly broader context, Lata. I would just say that both the MPC members and the ministry people, I think, really need to decide what is India's problem. Number one, you always have multiple problems. What is your top problem? Till fairly recently, the top problem of India has tended to be the fact that inflation was above what either the society was willing to accept, and therefore that got enshrined in a law which the MPC has to follow. Because the growth by and large was delivering around 7%. Now, 7 might be a little disappointing, but it's at the margin of disappointment. So I think once you conclude that the problem number one is no longer inflation, but the problem number one is that we run the risk of inflation prints, we getting increasingly used to 6-handle inflation prints. Please understand, we were used to 8-handle inflation prints, then we got used to 7-handle inflation prints, and now we are slowly getting used to 6-handle inflation prints, and that's not, and there is a risk that trend continues. So I think once you determine that your problem for the economy right now is slowing growth, at the same time inflation is you can say borderline, you're in the comfortable zone, right?
Yes,
you're going to be between 3 to 4% for most of this FI baseline projection.
Absolutely.
With that, then for you determine whether it's your interest rate policy stance, whether it's your liquidity stance, or whether it's your the stance from the fiscal authorities.
Okay. I take your point on that. You're making a strong case. I'll just tell you that what R.C. Bhargava thought was that if the liquidity situation improves and the government starts spending, which it normally does, as soon as it takes office, he was expecting demand to revive considerably in the second half. I wanted your thoughts on that, whether it just resolves itself because all these bottlenecks of government not spending and a dislocation in NBFC gets resolved, then growth picks up automatically. That one. And I also wanted to ask you, where do you see the currency now? With this fairly different, the question that Sonia asked you, a very different global environment in terms of the strength in the dollar, the fall in yields.
No, so I think as far as the fact that we now have a government in place and it is a decisive vote and a decisive majority, to that extent one expects them to take decisions with a lot more confidence. I think if you see Mr. Bhargava's interview, I also read in the newspaper today, I think there is a certainty that for the last 6 months demand conditions have been weak across a lot of sectors that deliver to the consumer, more to the rural consumer. There is also a certainty that nothing has changed since in this FI till May or so. So I think a lot of people have been expecting that post-elections there will be a U-turn. It's difficult for me to understand why, I can understand certain large mega projects not being put up because of elections, but to say people deferred consumption of soap or shampoos because of elections, it's very difficult to reconcile to that argument. And even in automobiles, I think if you read, I think it appears to be a hope that in the next half things will improve, and I also hope that does happen. I would just say that if you're a policy maker today, what is the risk of acting a little proactively as opposed to reactively? And I think, for example, going back to RBI, all RBI's actions in the last, ever since MPC has got formed, have largely been reactive. Once the inflation has come significantly below the projected rates, we have had rate cuts. Or, when the rate hikes took place, they were more on the basis of projected inflation because that's the bias of the MPC, or that's the mandate of the MPC. But now I think the risks of acting proactively and getting it wrong on creating asset bubbles or creating runaway inflation, to my mind, are relatively muted. And just to close that point off, I think there is, if you can wait for a few more months, wait for, say, the second half of this year, but if at that time the revival, as a lot of people are expecting doesn't happen, I think you clearly will have to end up doing a lot more. So to me, on balance, it looks like being a little proactive doesn't expose you to any risks, as much risks as being reactive.
Thank you very much, Hitendra Dave, for that very nuanced stance on growth and that it needs immediate attention.
And this hope trade that he spoke about